very comfortable holding sort of a more plain vanilla long only strategy, but with mechanisms to manage risk. And over history, we're up about 11% year to date.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Hello, and welcome to the Bull of Wall Street podcast. I'm Jim Worden. I'm one of the hosts. I'm joined with my co-host, Talley Leger, and our special guest this week is Katie Stockton. Katie, welcome.
Thanks so much. It's good to be with you guys.
So Katie, you and I have something in common. We're both CMT charter holders, and I was just looking at some of your information. It looks like you got yours a lot earlier than I got mine. It looks like you were the youngest woman ever to get the CMT at that time.
Yeah,
that's incredible.
2001. So I've been doing it for a while now. I actually studied technical analysis in college, believe it or not.
Oh,
and
wow.
That set me on the path. They had coursework. It was really very fortunate, and it's quite unusual too. So as part of our final exam, I already had the CMT level 1 when I graduated.
Oh, that's awesome. That's incredible.
Yeah.
So my journey was, I did the CFA. And it was so hard, and it took a little while to get it. And then I had all this free time on my hands, and I always wanted to learn technical analysis. And so then I did it just for fun. And I'm so glad I did it, because it's a whole new world outside of, fundamentals. And so, yeah.
Well, it's funny. I was speaking to JC Pretz, if you know him, and he said, well, the CFA helps you get the job, and then the CMT helps you keep it.
That's
I
right.
thought that was pretty well put.
Yeah. I've also heard CFA is for show and CMT is for the dough.
Yeah, that's another good one. But it's definitely, to have the dual charters is really very powerful and very much aligned with how we think about things. We think about technical analysis as a complementary discipline, less so than a standalone one. Listen, we are guilty of making decisions based solely on technical analysis ourselves. And yet we think it's a great sort of add-on to others' processes. So whether they really are wholly macro focused, fundamentally focused, there's definitely a place for the charts, because, you want to keep those trends on your side.
100% agree that the trend is your friend.
I was going to say, Katie, I also know a lot of technicians, and I saw kind of in the social sphere, you were doing some traveling. I think you were in the Middle East with a bunch of those technicians. I think I saw John Calovis and Julius de Kempenaer, maybe even Ralph Acampora was in the mix.
He was there.
He was. What were you doing? What was that all about? And how was your trip?
Funny. I'm like, it takes me, across the world to go see these folks.
Yeah.
we probably live within, 15 miles of each other for the most part. And yet, it was great. It was a CMT association conference, and it was based in Dubai, where they have a great footprint now. And as you can imagine, that the discipline has real popularity there. And there's also a big presence in India, not too far away. So it was a great conference, and it did bring a lot of really legendary technical analysts, including Ralph, who you
Oh, yeah. Ralph is the legend.
He really is. And he's, it's keeping him young, I think, just following the markets.
So I remember I worked for Prudential Securities back in the late 90s, and I think he was the first one that said Dow 10,000. And a lot of people were like, I don't know if I could ever do that. And like, yeah, I mean, that's to think of how far we've come from there.
He really stuck his neck out there, right? And did it in a very, sort of foundational way in methodology. I think he always had his reasoning, and people couldn't really argue against it because he had his tools. And that's how we think about things. So we're not often emotional about our biases, where they're coming from almost like a mathematical place. And Ralph definitely taught us that. And he did stick his neck out, though. I know he used to get, nasty letters in the same way that we all do
Oh,
today
no.
on Twitter.
Well, hopefully I'll make it to one of those CMT meetings. I haven't yet been to one, but that's my goal. I should have done Dubai because Dubai sounds amazing.
You should.
Maybe they'll have it there again.
Annual. Yeah, they will. That was the second annual. It was the Global Investment Summit. So they'll do it again. So definitely put it on your radar.
Nice. So Katie, tell us about your journey. I mean, you started doing technical analysis in college. You got your CMT and you work at some different places, and tell us kind of about that journey.
Well, we'll start maybe from now and work backwards, and I won't belabor anything because I know it's just my background. It's not the most interesting thing, but it definitely I've been on my same path all throughout my career of technical analysis, and now I have my own firm called Fairlead Strategies, which I founded in 2018. So this has been where I've spent the last few years in Connecticut. Providing technical analysis, research, and consulting to individuals all the way up to the biggest institutional investors. And we launched an ETF, or exchange traded fund, in 2022. And that's called the Fairlead Tactical Sector ETF, or TACK, TACK. So all the positions I had before Fairlead really were the accumulated the experience that I needed to launch the firm. And it's been great. I've really not looked back, and I don't know how much I miss working for bigger corporations. It's hard, but it's a little more stressful maybe, but it's been great at Fairlead. And so my last position was on Wall Street. I was largely a publishing sell-side strategist, a technical strategist. So publishing technical analysis research in the same way that I am doing today. But reaching primarily institutional investors through that. And so took that skill set and brought it here. And I had great mentors along the way. Started my career in San Francisco, working on the buy side, doing point and figure charting. And that's
wow.
The X's and the O's,
yeah.
You know. And before that, even during college, I had an internship that turned into a part-time job at Dorsey Wright and Associates. So, and they've sort of put out some great technical analysts over the years, really shepherding these students who usually were sort of focused on just finance, and then took to the technical analysis just by the nature of them being a local firm to where my university was. And so they helped place me in San Francisco. I kind of moved through my career, navigated the dot-com bubble, had some bumps in my own career, not unrelated, but ultimately came back to New York City, and which was great. It was a great move just because there is so much technical analysis to be had here, and such a great community of CMTs and otherwise. So landed at Morgan Stanley working on their technical strategy team for one, and we were publishing daily research and primarily U.S. equity centric. Now we do a little of everything. So we are focusing on things like the S&P 500, but also anything that relates, and generally can have an opinion about anything that has a price. So we'll look at the S&P, we'll look at 10-year yields, we'll look at gold, the dollar, crude oil, sectors, really, anything that influences folks in their investing. And so we've had good uptake from Main Street, not just Wall Street. That's what's one of the main reasons that I wanted to launch Fairlead, was to open up what we do to a retail investor and audience. And now a lot of financial advisors or RIAs are using us to help in their practices, because it is really added value, as you know, with your background. I mean, we feel that it's not necessarily something that should be used to predict where we're going to see the S&P 500 close at a certain time, because nobody knows that, but rather keep those trends on your side and help manage risk primarily. I mean, risk management is something that is probably more difficult than identifying trends. And I think the charts can lend themselves really well to it.
I'm glad you mentioned that, because like we have some models that we run that look at different factors. We look at value and quality and volatility. We look at momentum, and then we have trend as a factor. And some people think that momentum is trend. And they also think that technical analysis is just about, momentum. But like you mentioned, risk management, that's a huge component of technical analysis that some people just don't realize that, that world exists, that we manage risk too. It may be different than how a macro person looks at it or a CFA type looks at it, but it's important.
Oh yeah, without question. And also we can apply technical analysis over any time frame. So what I've found over the years is that that's so important to differentiate whether you're talking about or looking at a long-term time frame or a short-term one, whatever that may mean to you, because often you'll read macro research and it's very long-term in focus. So as much as there might be a bearish macro view, how much does that mean to the markets right now, right? So the charts can help almost, reconcile that between the long term and the short term. And so really important, I think, with that, especially as you consume research, fundamental research is often quite long-term as well. 12 to 18 months are price objectives. But in reality, a lot of investors think in more of like a quarterly type of mindset, because we don't want to underperform, indefinitely waiting for that price target. So I think momentum is what technicians are associated with, but in fact, long-term trend following can be incredibly added value in addition to that risk management piece. I ran into that too with my ETF, which is a very conservative long-term strategy, equal weights sectors that are working from a long-term trend following perspective, and then it has a risk-off piece, other asset classes to navigate drawdowns in the equity market, of which I don't feel like we ever have those anymore. But at least we have the ability to navigate through them. So, I think when people heard that I was launching a product, they instantly thought, okay, well, it's going to be thematics, it's going to be high flyers at the short term, fast moving, and it's not at all that. So I think people have said, okay, well, that's kind of interesting. Maybe there's more to it than just the, sort of looking for breakouts and trying to trade, AI stocks, that type of thing.
Hey, can I jump in there? So let's test it out. So I like what I'm hearing. Short-term, long-term. So I put a piece out last week about small cap, big picture. And one of the observations, this is for us, for WCG, one of the observations that I made, to your point, Katie, around small caps is the total return Russell 2000 relative to the 1000 looks like it's bottoming at a similar level to where it was back in 1999. That should resonate, because that's kind of where I started my career too. And I was like, is it always like this? It's probably the longest bear market that we remember anyway in the history books. But I like to put on my technical cap every once in a while and say things like the bottom of the chart is not support. But what is your lens kind of telling you or informing you there when it comes to the size cycle? And maybe talk to us a bit about breadth, because Jim and I have been noticing some kind of encouraging developments on that score. But what are you seeing, Katie?
Yeah, I think you're right to keep an eye on small caps relative to large caps. We're looking at the Russell 2000 as well versus the S&P 500 to that end. And indeed, there's like signs of life is the way I would put it. And yet I'd still call it more of a counter trend setup. So not a convincing turnaround yet, just in terms of trend following. The support level for the ratio, we do really focus on those. And we do also focus on an indicator called the DeMark indicators. We have these indicators that gauge trend exhaustion. Jim, you probably know
Oh,
those.
yeah.
Yeah, and they can be super helpful when it comes to identifying counter trend setups. So we've been watching all these things, and I think that we could be in the start of at least a more normalized period, right, between small caps and large caps, and that creates opportunity. I would argue that that's also the case for international versus US. Another big bear trend longer term in relative performance for international.
Yep.
But now signs of life for US or for international versus US in the ratios. Now, support discovery, turnarounds, it's all part of a process, right? A bottoming process. And I think for these long-term downtrends to officially reverse, we're going to see a little bit more of the same. Maybe it's a backing and filling, sort of some ups and downs that allows for that basing phase to form. So I think there's real promise there. It doesn't necessarily comment on the health of the equity market as a whole, because we're all, of course, measuring the equity market by the S&P 500, which maybe shouldn't really be the case. In fact, our ETF's benchmark is the Russell 1000 equal weight index, so the large cap equal weight. So maybe that's a more accurate market for most people, which, of course, doesn't have the same mega cap heavy concentration in the likes of NVIDIA, Apple, et cetera. And yet that's still what we're largely, watching as the so-called market. So I think too early to suggest that we're going to have sustained outperformance for small caps versus the S&P 500. But if the S&P does go into another bear cycle like we saw in 22 or a more prolonged range or consolidation, I think that would be an opportunity in a way to see that relative performance improve. It just wouldn't necessarily mean that in absolute terms, there's great returns, happening in the small cap proxies. So it's kind of a tricky relationship. It's almost like the small cap outperformance isn't always associated with strong tapes, but it's not necessarily mutually exclusive.
That's great.
That's fascinating. And so tell me a little bit about TACK. TACK is, by the way, congratulations. And I mean, you're an entrepreneur now, doing this, you got your own ETF.
I feel it every day, trust me.
Maybe someday I'll have my own ETF too. I know Dan Ives has got his, and, other people have got, Tom Lee's got the granny shot one, but TACK, tell us about TACK. Tell us about how those sectors work and what you're doing there and what you're excited about, what you're worried about.
Yeah. Well, we're always worried about a lot. And yet we're going to respect the trends and momentum, even if we're in disagreement with the way they're pointing, right? So what we're worried about is not necessarily, the way we're investing. So TACK is essentially a fund of funds, and I designed it honestly to be a holistic portfolio. So I threw half of my IRA in it, and ideally as something that created this great core long-term exposure that wasn't tech heavy, because it's so common for people to have too much tech in their portfolios if they're concerned about risk, right? Because if you have a tech heavy portfolio, tech, of course, is higher beta. It tends to exhibit downside leadership and upside leadership. So there's times to be heavy tech, and then there's times that you really don't want that exposure. So we wanted to create something that gave core exposure that had other sectors rewarded for their long-term momentum characteristics and relative performance. And then we also, I don't know if it's just my nature, but very risk averse. So I wanted to make sure that we had a way to navigate through the drawdowns, knowing that there are periods in which you really don't want to be invested in a lot of these sectors. So we'll use as our most recent example, which is when we launched the fund, energy was the only sector significantly in the green, right, for the year.
Yeah.
It feels so strange because it's ancient history at this point, right? So we actually only held energy for several months in the portfolio. So as much as it's an equal weight sector approach, we also have the ability to go fully what we're calling risk off, but it's a combination of short-term treasuries, long-term treasuries and gold via low price ETFs. So we can actually carry almost 100% exposure to these risk-off categories. And that's the dynamic nature of our technical model. So it's 100% systematic, but we developed the model, which I would consider to be sort of sophisticated technical analysis based on our own indicators and tools that we have always used. And that's things like momentum gauges and overbought, oversold metrics and relative performance indications. Those things taken together can be really powerful in helping you identify the most, sort of leverageable trends out there. What's nice about TACK is that it doesn't use leverage and it doesn't use derivatives. So I know that there's been such a wave towards these sort of complex strategies with active management appearing now in ETFs everywhere. But we believe that it doesn't have to be that complex. Simple is actually sometimes better and can be almost protective, right? If, where there's less unpredictability perhaps than there might be in the options market, that type of thing. So we're very comfortable holding sort of a more plain vanilla long only strategy, but with mechanisms to manage risk. And over history, we're up about 11% year to date. And it's beating the equal weight proxy, which is up, I'd say, 8.5% or so year to date. And we've limited all the drawdowns that are greater than, I'd say, 8 or 9% for the S&P since, the launch of the fund. So all of the boxes that we're hoping to check, we're managing to check.
That's fantastic. Well, congratulations. That's
Thank
great
you.
performance. So it's interesting. Energy was not the only thing we owned in 2022, but we had a large overweight to energy, and we had underweights in technology and some other areas that typically are higher beta.
Yeah.
It helped a lot. I mean, I remember energy was up. It was the only one that was up, I think.
I know it's the sector rotation is something that I consider to be low hanging fruit from the market, right? Because you can see every year after year, there's a big dispersion between the biggest winner and the biggest loser. And we're talking, 50, 60, 70% at times. So that right there gives you opportunity to take advantage of that relative performance. And you can do that through momentum gauges. We find that a long-term approach to investing really is the best. We've done all sorts of back testing here at Fairlead, and our conclusion is often the same, that you're really well served to eliminate noise through these long-term tools. We also know that's not necessarily practical for everyone, but that's where we wanted to start with our first investable product, is something that's rewarding those long-term momentum characteristics and trends, not changing too much through corrective phases, knowing that those corrective phases have a good chance of being a buying opportunity as opposed to the start of a bearish reversal, honoring the fact that markets typically trend higher, except for these periods, of course, during which we'd expect to manage risk. So we start with sort of a pie, which has 8 slices of 12.5%. And in a strong tape, we'll have 8 sectors. In a weak tape, we can have none. And then we'll divide it up between the other asset classes. So very, very dynamic. And I think this is the way things are going. Because not just from, sort of active ETF, that kind of category, but almost like a new way to think about a 60-40 type of portfolio or model, something that's dynamic and responds to the market, and also doesn't let you get into too much trouble when things are going against you. And that's very well suited to investors either who don't have a great risk tolerance or perhaps are on the verge of retirement and just really can't afford it. And so something that's much lower beta. So TACK runs super low beta, low correlation to the S&P and also its benchmark. So there's definitely a place for that in portfolios. And then there's also a place at times for the high-flying tech stocks that we've seen leadership from most recently. I mean, since the April low in the S&P, we haven't had much of a pullback. And of course, it's been right to have not only tech exposure in that category or in that type of environment, but also to be watching for breakouts and taking individual stock positions if you have that leeway in your portfolios to take advantage of strong companies doing good things.
Yeah, and I feel like we've been very much in a buy the dip type of environment. I know, Talley, you comment about that a lot. I mean, we talked, Talley and I were talking about some of the things we wanted to add back in April, and I mean, that was kind of a period where everyone just thought, wow, the Liberation Day is obliteration day. But we thought that, hey, look, this is good mean reversion and buy the dip type of strategy.
I was going to be there for that for sure when things get so climactic, right?
Yeah.
Well, that's where the discipline really kind of helps you out. But I was going to say, like, just listening to you talk, Katie, and hearing about your journey, it reminds me in some ways of my own, because I ran a tiny boutique called Macrovision Research for 5 to 6 years, and I developed a sector rotation model using ETFs, and I ended up writing a book about this stuff, and I did some sub-advising. I launched a style with a large, well-known RIA, and that took me to the buy side and wealth management and other characters like Jim Worden. But I was going to ask you about TACK, because you've been talking about it. Given your model there and everything you just explained, let's bring it back to the advisor, because that's really who the podcast here is for. But when talking to or helping advisors in your day-to-day, and that's what we do, how should we help them think about these kinds of kind of tactical shifts and sector tilts versus, I think, the typical thing or approach that they adopt, which is kind of these static long-term allocations? What would you kind of advise there?
Yeah, I think just, think about it differently, because the market changes. So we want to change with it and take advantage of not even just those buying opportunities like a Liberation Day, but the big trends. And we all know that, we're well served to be underexposed to equities during the 2008 types of periods. And indeed, for TACK, you look over the course of our back test, and there's only 3 periods in which it went pretty much risk off, and you can guess what those are. So I don't even need to tell you, right? So, to be adaptive in that way, it'll obviously protect you on the downside and start you at a higher level when you're getting back into that full exposure. And it'll do so with, without any emotion, without any decision or discretionary decision making to be had on the part of the investor. So there's real value to that systematic approach. And I think that technical analysis lends itself very well to, a more quantitatively rules-based model. So I think that it's just thinking about things a little bit differently. I know that advisors tend to want to put things in buckets or sleeves. And, a sleeve that might be appropriate for TACK would be a hedged equity type of sleeve. But in reality, it's not just that, right? It might have some of the characteristics of a hedged equity product. But because it has other asset classes and can carry up to 25% in gold, well, then it actually does look a bit different. And then that would be another point in regards to gold, is that that's a traditional as it pertains to the old 60-40 type of model, right? So it would be more equities versus fixed income. Maybe there would be a small gold slice in there too, but it wasn't sort of considered as the traditional asset allocation and static. So what's great about technicals is that technical analysis will set you on the right side of these trends via indicators that have binary responses to or takeaways from certain shifts, right? So the indicators are designed to reduce some of the noise and tell you when there's been a meaningful shift in trend. And that's what warrants that dynamic positioning, right? Because you don't want to be just continuing to average down in a bear market cycle. That type of behavior can be really pretty damaging. We've all felt that before in our own rights, right? So I think to have that adaptive approach is the way it's going, and that folks, rather than trying to bucket these products, they can think of it more in terms of what's my desired outcome, and then evaluate the characteristics, the sort of the risk reward profile of the product itself, and make a judgment that way.
That's great.
Super fascinating. I love how you describe and get into the detail on that. So I was going to ask about, like, your toolkit, and you got all these different things. I feel like technicians have got all these different tools. But what are the things that you're actually looking at? So you're looking at probably individual stocks and indices. These are probably going to be like equal weighted, but do you look at what's happening with commodity prices, and do you look at what's happening with currencies and like with gold, since gold's a component? I'm just curious, like how all of this comes together. Like if you're going to make a pie, like how much, what ingredients are you using for each of those? And then what does the pie end up looking like? And how are you positioned today? Curious.
Yeah. So the process often involves looking at a lot of charts, right? So people are always kind of curious, like, how do we get to our starting point? But we have a list of, I would call them top-down inputs. For me, that would be major equity indices, futures, international equity indices, different countries. We'll look at currencies, major currencies typically. We'll look at all sorts of commodities. And you can find opportunities somewhere at all the time, right? So even if equities aren't working well, then maybe platinum is, right? So we always have these things on our radar just to know what's working out there. Fixed income proxies. We have all of these things can work together to create a holistic picture. And so we look at everything that becomes the stuff of our research. So it becomes the stuff of our morning bullets that we're producing every day about markets and things that we find interesting. We might talk about a group level ETF, like the solar ETF, or we talked about dollar yen this morning.
Interesting.
Yeah, anything that looks kind of interesting and maybe that's on the verge of a change. We're inclined to feature natural gas might land in there. Mega caps are often in there. So whatever's on our minds, and that comes from just looking at the charts. That's a pretty subjective process, but there's a real methodology to identifying technical catalysts to act upon. And it's that methodology that you see in the charts in our research, and then also becomes the stuff of the methodology behind TACK and future strategies. And we're developing models and things of that nature. So the methodology is from my mentors. So there's no one, holy grail of methodologies. We wish there was, but Ralph and Tom Dorsey, some great sort of mentors that I've had over the years, Mike Hurley, and they've all showed me great tools like the cloud model and different moving average combinations and support and resistance levels from various inputs, stochastic oscillator, MACD indicator, of course. So all of these tools are become the stuff of our methodology. Now, our methodology isn't entirely static either. We're generally looking at the same indicators on each of the charts, but in different environments, we might weight them differently. And
interesting.
Someone today, and it's not done in necessarily a systematic fashion, but just seeing the character of the market and having to adapt to that. That's the art of technical analysis. I think, the character of the market since the April low has been actually pretty unusual. And I'm not saying it's never happened before, but you see all the comparisons out there, and some of them just miss mark, in my opinion, because we've had maybe 3-4 day pullbacks max since then. And so rather than focusing on the MACD, which would normally be an input, we did, off the April low, we really captured that low. But in May, we started to say maybe, it's losing some momentum. And we said that for about 3 weeks. And then I said, this is just different because we're still seeing breakouts unfold despite the things like the MACDs pointing lower. So we got on board with it as soon as we saw that breakout in June unfold by the S&P. And we decided at that moment, okay, this is not an environment in which the MACDs on the daily charts are adding a whole lot of value. So I said, we're going to smooth it out. We're going to use the 20-day moving average as our primary short-term momentum gauge or trend following input. And when that rolls over, well, then that's when we're going to start talking about managing risk from that S&P perspective.
Yeah.
So just adapting those tools, but generally using tools that you would read about in the technical analysis 101 types of textbooks.
I love it. I love how you're so adaptive with it. I mean, that's fantastic.
Yeah, the market makes us do that.
The market, yeah, the market is not, it's not a boring thing. Well, I feel like if the market was all run by AI, it would probably be very boring, very predictable, but we're all human beings, right? And so there's the people that are like scared and I want to get my money out. And then there's the people like, they want to put it all on black, right?
Yeah, it's true.
Roll the dice.
Yeah. And that, like, they can all benefit from technical analysis.
Yeah.
So can I just jump in? I had a question. I was thinking about divergences. And I think back to maybe 1999, heading into 2000, how one of the warning signs back then was this kind of weakening breadth or participation and that divergence between market internals and the headline indices. But what are you seeing there on that score? Are there any divergences that you're monitoring that might be worrisome at this stage?
Yeah, always. Honestly, there really always are. And this is why we don't use them as a primary input necessarily, but as like a way to understand the markets and where there might be opportunities or not. So on our radar, just as you cite, the breadth has been deteriorating since I'd say mid-August, maybe even early August by some measures. Cumulative advanced decline line for the NYSE stocks, diverging with the action in the S&P 500. Now, it obviously hasn't impacted the S&P 500 meaningfully yet, and that's exactly why we don't use it as a market timing device, but rather as a way to understand the tape better. And so we know that this tape, for other reasons also, looking at leadership and things of that nature, we can see it is pretty concentrated. And I know that's probably been belabored at this point, but that concentration in the mega caps is really meaningful. And it's contributed to a strong tape, or at least perception of, despite that weakening breadth. And so we want to just say, okay, well, we know this is a harder market for investors to take advantage of. So that helps us understand our clients. It helps us know that our probabilities are a little bit lower, honestly, on the individual stock level as we source ideas external to large cap tech, right? So we're pretty considerate of it, and it does guide our, our recommendations, some of our bullish and bearish charts that we're sharing on the individual stock level. So we feel an influence from that in our writing, but it's not going to be the thing that says, okay, now is the time to sell. This is where the trend is ending. It's just information. The way we think about those, which are, we call the market internal measures. So breadth and leadership and volume and sentiment, those are all really important, but they're not always the best market timing devices unless you have a big extreme, like at the April low. We don't often have those. I mean, I'd say like on average, maybe 3 times a year, we get our collection of market internals that we're tracking, which are pretty common. Again, things like new highs minus new lows, spreads between new highs and new lows, and the VIX as a sentiment input, fear and greed, and things of that nature. It's when they all blow out to like an overbought or oversold level relative to history, that's when we tend to get information from that. So when that happens in our research, we're really vocal about it. But otherwise, we're a little bit less vocal because they're not as important to market timing for us.
So that makes me think of Talley put together a sentiment index that was looking at some sentiment levels and combining with some other things, but like it got to like, what was it, like -3 standard deviations in the April lows. And so we kind of saw that as a bullish thing, that this is a,
rare.
Mean reversion. So like, very, very oversold.
You're right.
Yeah, that's, I mean, when you see those extremes, you definitely pay attention. And yet, right, we still want to see that momentum shift, right?
Yeah.
So the price momentum is still key. So if you get the extreme and then you combine it with a little bit of an uptick in a stochastic or a MACD, then it's even more powerful. And, it often means you're not going to buy on that down 3 standard deviation.
You're not gonna catch the falling knife.
Yeah, you
You're
might
gonna
wait
wait
a
for it to
couple
turn
days.
around a little bit, and then you can get in.
But that's okay, right? You want confirmation to put more probabilities in your favor. And I think it's a safer way to go about these major inflections. And, the indicators are sensitive enough, in our opinion, to capture the bulk of these moves, if not even, within a day or two at the pivot point. I do encourage people to respect, especially when the market's going down, that there is such a top-down influence that most stocks will bottom like on the same day. So as much as we spend a lot of time looking at support levels, the individual support levels don't matter as much if it's a broad-based correction.
Right. So I was going to say, and honestly, it feels like this is the kind of environment where rereading and studying the Kindleberger texts is probably going to help us more. It feels kind of like a frothy environment. But I wanted to go back to something that we were discussing earlier and kind of juxtaposing the fundamentals with the technicals, because in this, and we talk about this a lot, the health of the underlying earnings and the sheer power coming from that dominant tech sector, it feels very different from the dynamics that we saw when we started our careers back in 2000 or thereabouts, which really was bubble-like because it was built on pretty much nothing but sentiment. And this is very different, as you say. But I was going to ask you, when you have fundamentals saying pretty good things, earnings are double digits, and we like that as macro folks, but how do you balance that with the technical signals that you're seeing?
Yeah, we believe, or at least I believe, I think my team would agree that earnings are driving long-term trends, or fundamental trends are driving those trends. And it also helps build market cap behind the best companies. So for our ETF, the way we're kind of rewarding those good companies is by owning market cap weighted sector ETFs. So we know that when we have the tech sector ETF that we're using XLK, we're getting an oversized position or exposure to Apple and Microsoft, these companies that have been deemed as high quality by the market. So we're like, as technicians, we're trusting the market to reward the best companies with their market cap, which is one way to go about it. If you're looking for sort of emerging leadership, names that are unproven or just had some kind of turning point in their earnings trends, that's a little bit dicier, but for sure the charts can be there to help facilitate that kind of research, because we can see when basing phases develop and breakouts unfold. We can identify turnarounds, and we can do it in a pretty unbiased nature. So, if somebody wants to buy PayPal, which has been just, sort of can't get out of its own way, they've been well served to maybe wait for the breakout from that basing phase is just one sort of example of a stock that has not been trending higher. So I think the charts can be, very helpful to that end, and that we're respecting the fundamentals through simply respecting the price trends and kind of trusting the market dynamics to reward the best companies. There's always going to be divergences, and meaning that I think the CMT Association's motto, or one of their mantras, is something about navigating the gap. And it means that there are times at which there's a gap in what a stock should be doing when the fundamentals are saying something. So the charts can help you navigate that gap by understanding either broader market trends, price action, understanding what the sentiment is through the nature of identifying supply and demand for those individual securities at a time when maybe there's not even any data to use, right? Because we are usually offered fundamental quarterly data, right? So there's a lot of action intra-month or intra-data points for some of these companies. And a lot of that action is all about the market and not much about the company, right? So we're very much top down in our orientation as another way to navigate through the volatility that may or may not be related to the company's fundamentals.
That's good to hear because, Jim, you bought XLK back in the April-May period, and that was just one of those classic instances where we saw the earnings up here and the price just deviated so far below the fundamentals. We just didn't think it looked right and made the bet.
It's a great, I mean, it's been such a winner and it continues to win. And you are, by the nature of owning that XLK, getting the oversized positions in the mega caps that have done so well this year, or at least off of the April low. So I think it's, it's a good way to invest, but you still have to consider your overall exposure. And that's why we are then equal weighting the sectors. But the biggest difference between like an equal weight sector strategy and an equal weight strategy is that we're not carrying as much exposure to the bottom of the barrel, right?
Yeah.
So that's an important distinction. And any, study, if it goes back, 20 or so years, will probably tell you that the equal weight sector approach is a better way to go about it. And I think it definitely has to do with fundamentals.
Oh, 100%. And, there's some of the models that we run that are quant driven models that we separate, the core type positions that are all equal weight, and then the smaller positions that are more satellite. Those are all equal weight too, but it's enough weight to where, if it performs well, a 1% position can become a 2 or 3% position, which is fantastic. But if you buy it at like 10 basis points, then it may not really, it's not going to move the needle that much. But at the same time, not having 8% in NVIDIA helps on the day, not today, but like in the days when NVIDIA is down, right? We own 2%.
I understand. And the market will change. That much we know, right? So as much as we will try to understand the way it's acting at any given time, we can trust in one thing is that it will change on us. So we need to have adaptive strategies to navigate that, especially if we don't want to, be hands-on every day. And that's where I think the role of the advisor is so important, to be the fiduciary, to make sure that they're investing responsibly and not carrying so much exposure to a tech stock. Look at Meta. The Meta reaction to earnings led to a massive gap down.
Yeah.
So if you were really heavy, in Meta and you had a concentrated position, well, boy, that was tough, right? So that individual stock risk can be really detrimental at times. So there's sort of a happy medium depending on folks' risk tolerance to find where that single stock exposure isn't so high that it would impact it in a meaningful way.
Yeah, 100% agree there. Yeah, Talley.
Well, I was going to kind of dig into that risk management conversation a bit, because as Jim just described, and everybody does it differently. That's kind of where I'm going. But, he manages position sizes and usually starts trimming when things go above 3% individual positions. And we had Fred Meissner on, whom you probably know, and he talks about stop losses and raising stops the higher the price goes. And that's a great way, technical way to manage risk. But am I hearing it correctly from you that you do it by kind of giving each sector a fair shake and perhaps even kind of cross asset class diversification in managing risks? Is that right?
I think, it's a little of everything. So it's the diversification that you're achieving through those equal weight sector positions. There's the asset allocation, right, piece, that as a strategy towards managing risk, having the ability to move into the alternatives is key. And then also minding support levels. And it can be a trailing support, as Fred probably indicated, something like maybe a 50-day moving average. We like to tell people that, you don't necessarily have to wait for the 50-day moving average to be broken to sell a position that you're worried about, but keep an eye on the 20-day and its curvature.
Yeah.
So that's what, as mentioned, we have been doing for the steeper uptrends in the market right now, of which there's quite a few. And so there's ways to manage risk through simply using technical indicators or tools like support and resistance. And then you can just go with a traditional, percentage-based stop loss at a certain point as well, to keep it more manageable. We just always say that, make sure, wait for that confirmation, not just on the upside when you're looking for opportunity, but also on the downside. So we don't panic if we see something dip below a support level, but if it holds down there, okay, that's when it might be prudent to reduce that exposure. We're also big believers in using hedging strategies. So, knowing that there's taxable implications for moving around positions too much, we are wholly on board with inverse ETFs as a way to, just minimize exposure temporarily, not to own these long term.
Sure.
Go in and out when you feel that the risk is heightened, especially if you're carrying exposure that you feel is concentrated or has, too heavy exposure to one sector, that type of thing. We, TACK is one product for us. We, hope to develop more products that will check more boxes for investors and advisors. But tax discipline is in falling with all of those sort of risk management tools. There is a place for a product perhaps that is higher beta and following the momentum. Maybe the risk reward will look different for that type of product. But I think for different environments, either way, you want something that's adaptive.
I love what you said about how you're using, inverse products, and you could probably say the same thing for levered products. So as Talley mentioned, our audience here is advisors. And so we're always trying to educate that these things, and we don't use them. We don't use them in any of our models, but even then some advisors, they can do things on their own. But I always try to educate them that these special ETFs are trading strategy. These are not meant to be buy and hold, because the buy and hold for an inverse or a levered could be a disaster, right?
Yeah, but you're right there. They are special, and you can use them for certain, themes, or you want to push a little bit harder on something because you have a good understanding of it. So I don't think it's a careless, exercise to use a leveraged product. But I think I wouldn't get married to it. I would also, if there's a way to be more systematic in how you're approaching it, and that could either just mean that exactly what you're willing to risk, could be as simple as that, or you have some trend following technical or quantitative, sort of strategy that you're at least following loosely. And it could be, it doesn't have to be sophisticated or complicated. It could be as simple as, I'm not going to buy a leveraged product that's below its 50-day moving average. Something that will keep you honest and not, just gambling, right? So we just like to have a system, and that's why even for the sector rotation strategy, which of course is employing no leverage, we found that because the advisors that we have as our research client, they're very, smart, tuned into the markets, but they didn't really have time necessarily to be managing a higher frequency type of trading strategy, right? So it was in their interest to develop something that could do it for them, right? And then create a nice tax wrapper around it. So that was part of our impetus. But the point is more that, unless you can really watch it every day and follow some kind of methodology, maybe it's not the best idea, right? To trade some of these higher flying types of products. And then there are also taxable implications there too. And some firms don't even allow that. I tried to buy an inverse ETF in my own account at my advisor's office, and I was not allowed to do that.
That's interesting. Well, and I love how you say it's got to be rules based. There's got to be something that I think the biggest area where advisors can sometimes get hurt or clients, if they're doing it themselves, they can get hurt is if they just kind of like buy it and forget about it. It's cruise control. Like this is not meant, it's not designed for that.
Yeah, and that's it kind of brings it full circle to that the old buy and hold isn't necessarily appropriate in this environment where there's big ups, but there's probably also someday going to be a big down. And the traditional buy and hold strategies that to me were the stuff of much different type of market. I mean, just look at a monthly bar chart of any of these indices, and you'll see that the swings that we see are much more dramatic, right? And we can blame it on anything we want, maybe passive ETFs. It honestly doesn't really matter. We just have to learn to navigate through that. Yeah. And I think that's why the old buy and hold is a little bit less responsible than it used to be. So, if there's a way to, I'd say, still mostly buy and hold, but at times, manage the risk of a downdraft or a corrective phase that's significant, make sure you have cash to put to work. Those are the more responsible ways to approach it.
So that's probably a good question to ask. So what kind of common or the most common mistakes do you see advisors making when trying to implement these kinds of momentum or trend strategies, as you call them, and what would you do to coach them differently?
Yeah, I guess the first thing I would say is to have a system, and again, not necessarily anything sophisticated or complex, but know exactly what your entry and exit rules are going to be, and to make sure you stick to it. And, again, they can be looser rules. So you're not necessarily, you have some flexibility within that context, but to at least have that context. I think the biggest problem I saw was, let's say an advisor would believe in the financial sector for any myriad of reasons, right? He read some macro research that was really fascinating. He feels that the regionals have, good loans, whatever it may be, right? So they made that decision based on one thing and bought financials, and they're making a bet without any attention to all the other sectors, right? And also with not enough attention perhaps to the chart. So I think it's just a matter of, not just investing based on stuff that you're reading that resonates with you. Because I know we're all inclined to do that. We hear a good story, right? To not let it be led just by the good story, to let it also be led by the market and its action. So I think that it would be more like they're just going for something that they believe in, but not having, I guess a systematic approach to investing in that sector. So that would be the biggest mistake that I saw. And honestly, I think even at times, some of them would say, I owned it. I felt like I should have gone out a while ago and I just didn't get around to it. Not to say that they forgot about it, but they were kicking themselves for not having an exit discipline. We actually helped some advisors only with an exit discipline. It's easier to find reasons to buy things, right? That good story, but it's harder to find a way to know when to sell, and the charts will give you that binary takeaway at times. So, and some of the folks that we'll talk to are really very long term, and for them, we'll just look at the monthly charts. So we're only look. That's what TACK does as well. In fact, only looking at monthly bar charts and those indicators, and we purposely will put off to the side our dailies and our weeklies in order to understand the long-term trends without getting sort of swayed by the noise.
This has been super, super helpful, Katie. We appreciate your time. I know we're coming up here on the hour. I don't think I have any other questions to ask you, but thank you so much for taking the time to spend with us.
Of course, Jim. Yeah, it's great to see you guys, and thanks for this showcase, and for TACK and for what we're doing here at Fairlead.
Yeah,
and, it'll be interesting to see if the market ever does change. We'll see.
Well, you mentioned indexes, and we did have a prior podcast guest that talked about all this money going into indices, and it does make me wonder, if we need to kind of look at things a little bit differently just because there's so much money going in here.
Yeah.
Indiscriminately buying whatever the biggest names are. So
I know it's been pretty remarkable, and I think we can use these momentum gauges to help us, guide us through it without getting too caught up in the narratives out there. And yet, we know or can trust that when it changes, it could change pretty dramatically.
Yeah.
Right? So, what we don't want to find ourselves is in kicking ourselves for not having some way to manage risk through that turnaround.
100%. I think that's a good way to leave it. Anything else to add, Talley? Any other questions?
Well, maybe you could land the plane, Katie, with this one. What's your single most underappreciated indicator or a group of indicators that every advisor should be looking at right now?
Oh, yeah, that's hard. We are pretty traditional with our momentum gauges like the MACD indicator. And, I've been asked before what I would take to the deserted island, and that probably would be it. I love a MACD histogram. So that's a good trend following tool, but we love the DeMark indicators. The catch is it's a third-party service, so you have to pay for them. But we find that to have something that can tell you if a trend is exhausting itself is really a great tool to have, because we can identify the trend these days fairly easily through all of the tools. And we have such capacity now with the software that we can use. But those trend exhaustion indicators are harder to find. And so when you can, it's, the trend is your friend until it's going to end. Well, if you have something that can say, well, this is getting a little overstretched over whatever time frame, maybe it's something different than the DeMark indicators for the next person, but that can be very, very helpful. I know people like to use candlestick patterns. So there are some great ways to get to that information.
Do you ever look at Elder Impulse? That's one of the ones that I look at, is the Elder Impulse, both the weekly and the daily.
No, but that sounds great. So we'll look at that on our end.
This is one of the many that uses MACD, but it also looks at the change in the histogram, and I also like to look at the directional movement, like with the
DMI,
trends.
Yeah. See that, and that's
DMI.
It's a great point in that there are so many tools out there.
So many tools.
There's no one holy grail, and I think that one of the keys is just to go back to the same tools, because you'll get to know the nuances of them.
Yeah,
the DMI probably has characteristics that you now know really well. RSI is very common, but I don't use it. So when somebody says, "Well, what do you think of the RSI?" I say, I honestly don't know, because I just don't use it enough to have confidence in my biases. So
I think I saw a clip of you within a few weeks of me doing something similar using JDK's RRG. So that's in the toolkit too.
Yeah, we love that. It would a great way to visualize rotation. And
we love it too.
Especially with clients. I think it's helpful. We publish, RRGs all the time to make a point about whether sector rotation or even subsector rotation, and we find a lot of value in that too. I call them snail trail charts.
Oh yeah, we call them kind of like comets. It's like outer space.
Here's company too. Come and dance on our floor. Take a step that is